Hello traders, you're welcome to my video on the slow stochastic indicator. So do you want to know how to spot trend reversals before they happen? Or are you struggling with false signals and late entries? The slow stochastic indicator might be the tool you need. In this video, I'm just going to break down exactly how the slow stochastic works, how to use it for high probability setups, and how to combine it with other indicators for maximum accuracy. Okay, let us just quickly add the slow stochastic indicator to the chart. All right, so this is the slow stochastic indicator. I'm just going to make it thicker. All right, I'm going to make it thicker. Yeah, let's do that. All right, now this is the slow stochastic indicator. Okay, but before we dive in, make sure to hit that like button, subscribe to the channel, and turn on notifications so you never miss, further uploads, right? More powerful trading strategies. We're going to be starting with the basics real quick. The slow stochastic indicator is a momentum oscillator. All right, it's a momentum oscillator that helps traders identify overbought and oversold conditions. Okay, so it is based on the standard stochastic oscillator, but the slow version smooths out price movements, making it less reactive and more reliable in identifying true trend reversals. So the slow stochastic oscillator, you can see that it moves between 0 to 100. The indicator ranges from 0 to 100. All right. Now, let us just quickly change the setting of this. Yeah, I should have just changed it at the onset. Yeah. So you will see that the indicator ranges from 0 to 100, right? And when the percentage K and percentage D lines cross in specific areas, they generate potential buy and sell signals. So you will see that the percentage K line is 14 period, the default. The percentage D, that is the smooth D, is 3 for the default. Yeah, you can actually modify it according to your taste, but the default settings is actually fine. So when you have a crossover, basically the signals are given by the crossovers. It's the crossover that gives the signals. Okay, so there are 3 main zones to focus on: above 80, below 20, and the midline. All right, sometimes the midline might not, might not be visible, in maybe some indicators or some platform. But basically, the midline is the 50 level. Okay, the 50 level is the midline. All right, so those are the 3 levels to pay attention to. The overbought zone means that the market may be losing upward momentum and could be preparing for a reversal or pullback. Then below 20, which is the oversold zone, it means that the market may be losing downward momentum and could be setting up for a bounce. All right, while the midline, which is the 50 level, is a key level where price transitions between bullish and bearish momentum. Okay, so in as much as your main focus is on the overbought and oversold, sometimes you can just pay attention to whether the indicator is above the midline or below the midline. You can actually know that even though the midline is not displayed on this indicator, it is not showing, a particular line is not showing to represent the midline, but you're going to know when it's above or below because, of course, you're going to be seeing the value. You can see currently the value of the white is 86.17. The value of the red is 79.62. So when it is above the midline, you're going to know if it's above 50. The values are above 50 or below 50. Okay, so basically when the white line crosses above the red, depending on your color settings though, yeah, so when the faster moving, the percentage K crosses above the percentage D, yeah, it shows a potential bullish move. All right, and then especially when they are both climbing above the oversold territory. For example, here they were climbing above the oversold territory. So that showed that there was some bullish momentum. But shortly afterwards, it entered overbought and dropped down again. And you can see how price was reacting to all those movements. Okay. But this was just a pullback though. That is the reason why it's better to use this indicator in a trending market, so that whenever you have a buy signal in a buy trend, you can be almost certain that that buy move is going to be significant. For example, you can see that we had a bullish crossover here coming out from the oversold territory, and at that time you can see that price was just bouncing off a notable support zone, right? Price was just bouncing off a notable support zone, and you can see that this trend line shows that, you know, this is actually a bullish trend. Yeah, you can see this is actually a bullish trend. So as a result of that, this signal, there was a confluence. Yeah, this signal was a very, very valid signal. Yeah, so you could have considered entering a buy, you know, setting your stop loss below the previous swing low, and your take profit can just be at, you know, resistance zones, or you can just wait for the stochastic, the slow stochastic, to enter the overbought territory and start crossing back downward. So the reverse is the case for a sell. Okay, now let's talk about slow stochastic settings and how they apply to different trading strategies. Now, for scalpers and day traders, you can actually decide to use 5 for the smooth K and maybe 3 for the smooth D. Okay, for faster signals that respond quickly to price action. Then for swing traders, you can decide to use maybe 14 and 3, the default. Okay, it provides a balanced approach, filtering out unnecessary noise while still catching reversals. Then for long-term traders, you can consider using 21 here and 5 here. Okay, it's a setting that smooths out longer trends and avoids premature exits in larger time frames. So these settings can be adjusted based on your preferred time frame and market conditions. So do not be afraid to test them out. Okay, so now let us go over two powerful strategies that you can use, you know, with the slow stochastic indicator. The first is the crossover strategy. Basically, when the percentage K line crosses above the percentage D line in the oversold zone, it could signal a potential buy opportunity. And when the percentage K line crosses below the percentage D line in the overbought zone, it may indicate a sell opportunity. But not every crossover means a trend reversal. Okay, so always look for additional confirmation. Now, the next strategy is the divergence strategy. When price makes a new high, but the stochastic, the slow stochastic makes a lower high. For example, we can see what happened here. We can see that there was actually a new high formed here, but guess what? The slow stochastic made lower highs. So when such a scenario happens, it shows that a reversal is imminent, a possible reversal. Okay, it shows that, you know, momentum is getting weak. So in this case, bullish momentum was getting weak. That was why this divergence happened, showing that a reversal may be incoming. And guess what? We actually had a sell move. All right. So on the flip side, when price makes a new low, but the slow stochastic makes a higher low, this is a bullish divergence. Okay, so that signals a possible trend shift to the upside. This was the case of a bearish divergence. Okay, the reverse is the case for a bullish. Now, while the slow stochastic is powerful on its own, it becomes even stronger when combined with other indicators. All right, some killer combos include the slow stochastic with the RSI. Okay, you can actually combine the slow stochastic with the RSI when both indicators show overbought or oversold conditions. It adds extra confirmation for a potential reversal. Now, another indicator you can consider adding is the moving average. Okay, you can actually combine the slow stochastic with the exponential moving average. Basically, you can use the 50 EMA, or you can use the 50 EMA or the 200 EMA, depending on your trading style. All right, just to confirm the overall trend before taking your stochastic signals. Okay, another indicator that you can decide to combine with the slow stochastic is the Bollinger Bands. Yeah, you can combine the Bollinger Bands with the slow stochastic. Okay, when the slow stochastic reaches the extreme zones while price touches the outer Bollinger Bands, it strengthens the signal for a potential reversal. So using these combinations can help reduce false breakouts and give you a stronger edge in your trading. So is the slow stochastic indicator worth using? Absolutely. It's an effective indicator for spotting trend reversals, confirming momentum shifts, and improving trade timing. So if you found this breakdown helpful, make sure to hit that like button and subscribe to the channel for more powerful trading strategies. Also, drop a comment below and let me know, have you used the slow stochastic indicator before, and what is your favorite strategy? Turn on notifications so you never miss an upload. Until next time, trade smart and stay disciplined. Happy trading.